In every major financial collapse in the last 100 years, a small group of ordinary people quietly got rich. Not hedge fund managers, not insiders. Ordinary people. A roughneck, a nurse, an IT manager who made one specific type of decision at the worst possible moment. Not the same asset, not the same method, not the same amount, but the same underlying move. And almost nobody noticed because it required doing something that feels completely irrational at the moment you do it. It requires buying when every instinct, every headline, every conversation, and every financial advisor is telling you to wait, protect, and stay out until things are clearer. It requires recognizing that the price on the screen and the actual underlying value of what you are looking at have temporarily and dramatically separated. And it requires acting on that recognition before the gap closes. This is the part nobody talks about. Not the crash, the pattern that runs through every crash. James Galbraith was 38 years old, oilfield roughneck from Midland, Texas. He had $1,200 in savings in 1929 when the crash hit. By 1931, when the Dow Jones Industrial Average had fallen 89.2% from its peak, James had kept his $1,200 intact. Not in a bank, many were failing weekly. Not in stocks, which had lost nearly everything. Simply in cash, held through the chaos. And then, in 1931, he used $80 of it. $80 out of $1,200. He leased mineral rights on 40 acres of land in the Permian Basin at $2 per acre. The normal pre-depression market price for those same rights had been $15 to $20 per acre. In 1931, at the bottom of the worst economic collapse in American history, a desperate seller needed cash more than he needed mineral rights on a piece of West Texas scrubland. This is where most people would have hesitated. James did not. In 1939, an oil company made an adjacent discovery in the Permian Basin. James was offered $4,200 for his lease rights. His $80 had become $4,200, a 5,150% return in 8 years. Not because James was a financial genius, not because he had inside information, because he had cash at the exact moment when a specific asset was priced at a fraction of its real value. And he was willing to act when everyone around him was frozen in fear. In February 2009, at the bottom of the global financial crisis, Maria Reyes was 43 years old, registered nurse in Phoenix, Arizona, $62,000 in savings. The Phoenix housing market had collapsed 54% from its 2006 peak, according to the S&P CoreLogic Case-Shiller Home Price Index. Houses that had sold for $219,000 in 2006 were now in foreclosure, listed at $65,000 to $70,000. Maria bought one. A 3-bedroomed foreclosed house in Phoenix for $68,000 using an FHA loan with a $6,000 down payment. She rented it immediately for $900 per month. By 2019, that house was worth $248,000. Over 10 years, Maria had collected $108,000 in rental income. Total return on the $6,000 down payment? Approximately $240,000, a 3,900% return. Not because Maria had sophisticated financial training, because she understood one thing that almost every other person in Phoenix in February 2009 did not. A house that had sold for $219,000 3 years earlier in a city with a growing population and consistent long-term housing demand was not worth $68,000. It was temporarily priced at $68,000 because panic had removed rational buyers from the market. That distinction between price and value is what most people never make. On March 23, 2020, at the exact bottom of the COVID crash, David Okonkwo was 35 years old, IT manager in Atlanta, Georgia, $44,000 in savings. The S&P 500 had fallen 34% in 33 days, the fastest bear market in recorded history. The news was apocalyptic. A global pandemic, lockdowns spreading across the world, unemployment claims spiking at a rate never seen in modern history. Every signal said to wait. David invested $35,000 in an S&P 500 index fund on March 23, 2020, the exact day the market hit its COVID low of 2,237 points. By December 2021, that position had grown to $74,900, a 114% return in 21 months. Not because David had predicted the pandemic would end. Not because he had access to vaccine data or government policy information. Because he understood that the S&P 500 had just fallen 34% in 33 days, faster than any prior crisis in the data record, and that, in the documented history of the last 100 years, every prior 30% plus decline had eventually produced new all-time highs. He trusted the pattern more than he trusted the fear. 3 people. 3 collapses separated by nearly a century, 3 completely different assets, 3 completely different methods, 3 outcomes that look miraculous from the outside and entirely logical from the inside once you understand the framework that connects them. My name is Ban. Most financial channels cover the crashes, almost none cover the people who got rich during them. I spent 3 months tracking these cases down through the WPA Federal Writers Project archives, the Case-Shiller historical housing data, the NEBR official recession dating records, and the documented accounts of ordinary Americans who made the moves that look obvious in retrospect and felt terrifying in the moment. What I found is a pattern consistent enough across 90 years of data that it stops being coincidence and starts being a framework. That framework is what you will have by the end of this video. If this is the kind of financial history that should exist on YouTube but almost never does, real people, real numbers, real outcomes, subscribe now and hit the bell. Every week we go deeper into what the data actually shows. The framework connecting James Galbraith, Maria Reyes, and David Okonkwo has a name. I call it Stage 5 positioning. And to understand why it works, you need to understand the 5 stages that every major documented financial collapse has moved through. Stage 1 is the expansion phase. Asset prices rise. Credit is easy. Leverage builds. The economy feels strong. This phase typically runs 7 to 13 years. The 1920s boom ran from 1921 to 1929, 8 years. The post-2008 recovery ran from 2009 to 2020, 11 years. During Stage 1, asset prices get disconnected from their underlying productive value because cheap credit allows buyers to pay more than the asset's intrinsic worth. The gap between price and value widens slowly. Most people do not notice it happening. Everything feels like progress. That is exactly when the risk is building. Stage 2 is the trigger event. A catalyst, a bank failure, a pandemic, a market shock, exposes the gap between price and value. Asset prices begin falling rapidly. The speed of the fall creates panic. Panic creates forced selling. Forced selling drives prices further below intrinsic value. The panic becomes self-reinforcing. This is where everything changes, quietly and then all at once. Stage 3 is the maximum fear phase. This is the part nobody wants to live through. Headlines are apocalyptic. Smart money is paralyzed or has already repositioned. Retail investors are selling at any price to stop the psychological pain of watching their portfolios decline daily. Forced liquidations from margin calls and institutional redemptions push prices to levels that bear no rational relationship to the underlying productive value of the assets being sold. This is where the $80 mineral lease happens. This is where the $68,000 house happens. This is where the 2,237-point S&P 500 happens. The prices that generate the greatest historical returns are only available during the moments that feel the most dangerous. Stage 4 is the drift. Prices stabilize at depressed levels. The panic subsides. The news is still terrible. Unemployment is still elevated. Experts appear on television arguing that the recovery could take a decade. Financial media run stories about a new normal of structurally lower asset prices. But the forced selling has exhausted itself. Most of the people who were going to sell have already sold. The prices stop falling. They sit there, far below their stage 1 highs, generating no excitement, attracting no interest, providing no psychological reward. This is the part nobody notices, and this is where most people get it wrong. Stage 4 drift is where panic buyers sell because the psychological pain of watching their portfolio sit flat overwhelms their original thesis. Stage 5 investors hold through it. That difference in behavior is where the extraordinary returns separate from the ordinary ones. Stage 5 is the redistribution. This is where James Galbraith, Maria Reyes, and David Okonkwo were operating. Stage 5 is when people with liquid capital, those who either exited before the crash or protected their savings through it, begin deploying that capital into assets still priced at Stage 3 and Stage 4 levels. The returns are not the product of perfect timing. They are the product of buying assets at a significant discount to their intrinsic productive value, holding through the recovery, and having the capital available to act when others cannot. Wealth does not disappear in a collapse. It transfers to those who prepared for the moment before it arrived. Now here is what the data shows about why most people never reach Stage 5, and it is not because they are not intelligent enough. The single most common reason ordinary people miss Stage 5 is lack of liquidity at the wrong moment. Most people who watched the 2008 crash unfold had their savings in the same asset classes that were collapsing. Their house was down 30%. Their 401k was down 47%. Their stock portfolio was decimated. They had no capital to deploy, nothing left to act with because all their savings were already denominated in the assets that had just crashed. Maria Reyes had $62,000 in February 2009 because she had kept it in a savings account earning almost nothing since 2006. Her financial advisor had told her repeatedly that cash was a poor long-term investment. He was right about the long term. He was entirely wrong about that specific moment. Her $62,000 of so-called unproductive cash was the instrument that generated a 3,900% return on her $6,000 down payment. David Okonkwo had $44,000 because he had been saving aggressively in a high-yield savings account since 2018 and had not yet moved it into equity markets when the crash arrived. He had been intending to invest it for 2 years. His delay became his Stage 5 position. And James Galbraith had $1,200 because oil field roughnecks in West Texas in the 1920s did not have easy access to margin accounts and leveraged stock portfolios. His lack of access to the financial system being destroyed was the accidental protection that left him with cash when everyone else had been wiped out. The framework produces a specific set of rules that connect all 3 cases across 90 years of documented history. These are not abstract investment principles. They are the specific mechanics of what James, Maria, and David each did, extracted and made replicable. Rule 1. You cannot participate in Stage 5 if you do not have liquid assets outside the collapsing system. Historically, Institutional investors who have navigated multiple cycles hold 15 to 20% of their savings in instruments that do not decline during a crash. Short-duration treasury instruments, physical cash, or gold. Not because these assets produce strong long-term returns, because Stage 5 only happens to people who have something left to deploy when assets are priced at Stage 3 levels. Rule 2. You need a specific predefined entry threshold for each asset class you intend to buy, so that when the panic is at its worst and every instinct tells you to wait, you already know exactly what price level triggers your action. Maria's threshold was the Phoenix Case-Shiller Index 50% below its 2006 peak. She had done the calculation before the crash arrived. She knew at what price level Phoenix real estate represented a genuine value purchase regardless of the economic environment. When the index reached that level in February 2009, she acted, not because she felt confident, because the number said to. This is where most people get it wrong. They wait for confidence. The data says to wait for the number. Rule 3. You hold through Stage 4 drift without flinching. The 3,900% return on Maria's $6,000 down payment required 10 years. The 5,100% return on James's $80 required 8 years. The 114% return on David's $35,000 required 21 months. Stage 5 returns do not arrive quickly. They arrive eventually, and they compound from prices so far below intrinsic value that patience is rewarded with outcomes that look extraordinary from the outside and feel inevitable from the inside. Now here is where the 2026 data becomes directly actionable. Stage 5 opportunities do not wait for your schedule or your convenience. They appear at specific, identifiable points in the asset cycle, and the data provides pre-computable thresholds for each major asset class that any person can calculate today before the next disruption arrives. For real estate, the Vanguard Real Estate ETF, ticker VNQ, falling below $70 represents approximately a 40% decline from its 2021 high of approximately $115. In documented instances, every 40% or greater REIT index decline since 1993 has seen full recovery within 5 years. Every one. Maria Reyes's Phoenix entry signal, Case-Shiller 54% below peak, was a real estate Stage 5 signal. VNQ below $70 is its modern equivalent for diversified real estate exposure without the concentrated risk of a single property. For equities, the S&P 500 falling more than 30% from its most recent all-time high on above-average volume, with the VIX above 40, this combination has historically preceded Stage 3 exhaustion in 1932, 1974, 2003, 2009, and 2020. David Okonkwo's entry on March 23, 2020 met all three criteria simultaneously. The S&P was down 34%, volume was extreme, and the VIX had spiked to 85, its highest reading in recorded history. The Fred series for S&P 500 historical prices and the CBOE VIX data are both publicly available and free to track. For real assets, the James Galbraith category, the principle applies to any physical productive asset that has been forcibly sold below its productive value by a motivated seller in financial distress. In 2009, it was Phoenix foreclosures. In 1931, it was West Texas mineral leases. In 2026, the equivalent category may be commercial real estate, which has seen steep declines since 2022 as remote work has restructured office demand. The MSCI US REIT Index Office Subcomponent and local commercial real estate distress data from county recorder offices are the modern equivalents of what James Galbraith was reading when he identified that motivated seller in West Texas. Let me bring this back to where we started. James Galbraith's $80 lease on 40 acres of West Texas mineral rights in 1931 generated 5,115% over 8 years. He was a roughneck. He had $1,200. He kept it safe through the collapse. He identified a specific asset at a specific price disconnected from its productive value. He acted at the worst moment in American economic history. He held for 8 years. The Permian Basin oil discovery did not happen because James was lucky. It happened because West Texas has oil beneath it, and James had leased the rights above it at a price set by panic rather than by geology. Maria Reyes's $6,000 down payment on a Phoenix foreclosure in February 2009 generated $240,000 over 10 years. She was a nurse. She had $62,000. She had done the calculation before the crash. She acted in maximum fear. She held for 10 years. The recovery did not happen because Maria was lucky. It happened because Phoenix has sun, population growth, and job creation, and houses in Phoenix are worth more than $68,000 regardless of what a panic-driven foreclosure market said in February 2009. David Okonkwo's $35,000 S&P 500 investment on March 23, 2020 became $74,900 in 21 months. He was an IT manager. He had savings he had not yet deployed. He acted on the day the data said to act. He held. The recovery did not happen because David was lucky. It happened because the 500 largest companies in America continue to generate revenue, earnings, and cash flow, regardless of what a 33-day panic-driven sell-off implied about their collective value. 3 crashes, 3 assets, 3 ordinary people, 1 framework. The crash creates the price. The price is what makes the return possible. The return is available to anyone who enters Stage 5 with liquid assets, a predefined threshold, and the discipline to act when the data, not the emotion, says to act. The question for 2026 is not whether the next major disruption is coming. Historically, every documented collapse has eventually been followed by Stage 5. The question is whether you will be in the position James, Maria, and David were in, with something to deploy, or whether your savings will be entirely denominated in the assets that are falling when the opportunity arrives. Stage 5 does not care how smart you are. It cares whether you have capital available, and it cares whether you have done the calculation, the specific threshold calculation for each asset class before the panic arrives. Because when the fear is at its loudest, the calculation is the hardest to make clearly. The only way to act correctly in Stage 3 is to have already decided in a moment of clarity what price constitutes your entry point, so that when the market delivers that number, you execute the plan you made calmly rather than the impulse you feel in terror. Crashes do not destroy wealth. They redistribute it to those who were ready before the moment arrived. This is Ben. Stay sharp out there.